Hello, my name is JJ Risha. I am a serial entrepreneur with several successful exits. I'm also a member of Techos Angels and also a business advisor for startup businesses and small businesses looking to grow. Today, we're going to talk about break-even analysis. So, what is a break-even? A break-even is the point in time where a business has no loss and has no gains. It's a point in time where the profits are zero, meaning that your total revenue is equal to the total operating expenses that are required to run your operation. Regardless if you're a startup business, or if you are a Fortune 500 company, or you are a small business that's been around for a few years. Any business needs to understand what is their break-even. You can generate a break-even based on an hourly basis, based on a daily basis, weekly basis, yearly basis, monthly basis, etc. So at any point in time, you'll be able to understand if you have broken even for that specific period or not. So in order to analyze a break-even, you would need to understand what is an income statement and or what's also called a profit and loss statement. This presentation assumes that you already understand what a profit and loss statement or an income statement is, because we're going to change this income statement and make it look a little bit different, and we're going to call it management income statement. So, as you see on the slide, an income statement, basic anatomy looks like the following. Total sales minus the cost of sales equals to gross profit. You can also do that as in a percentage as a gross profit or gross margin percentage. Minus the operating expenses equals to the net profit or the net profit before tax. Again, a basic income statement anatomy is total revenue minus cost of sale equals to gross profit or gross profit margin minus the operating expenses equates net profit or net profit before tax. In order to understand costs, we need to split the cost into two different categories: variable cost and fixed cost. It's important to understand these because without understanding your cost structure, you'll not be able to analyze your break-even. So, what is a fixed cost? A fixed cost is the cost that is not affected by a sale, meaning regardless if you sell a product or a service, you will have to pay or you will incur that cost, meaning rent, as for example. You will need to pay that rent regardless if you make a sale or not. You will need to pay salaries to your employees regardless if a sale is made or not. So that's fixed cost. So when you're looking at your income statement, you would need to basically categorize the fixed cost and also categorize the variable cost. So talk about what is a variable cost. A variable cost is a cost that is directly associated with a specific sale. For example, the raw material that constitute building a product, or the preparation and the hours that are needed in order to prepare for a sale, or of a specific service or a product. Commissions that are paid for a sale. So if you're paying someone commission when they sell a specific product or a specific a service on your behalf, so whenever that sale occurs, the commission is associated with it. Thereby, it is a variable cost. Royalties are also variable costs. So if a sale causes a specific expense, it's considered variable. If a sale does not cause an expense, it's considered a fixed cost. There are also in certain situations where a cost could be either fixed or variable. In that situation, you can do one of two things. One way of doing it would be to really just assume that it is fixed, or you can kind of create a percentage. If it's, for example, for this example could be maybe your telephone, outgoing calls to make sales versus versus the telephone that you need in order to conduct business. So regardless if you are making a sale or not, you still need that phone. So you can categorize it and split it as 20% is for outgoing, 80% is for other business. So you can consider the 80% as fixed and the 20% as variable. Next, we're going to talk about the management income statement. What is a management income statement? A management income statement is the same profit and loss income statement that you're used to from your accounting system, but with a little twist to it. So we're going to combine the cost of sale with the variable costs that you segregated or that you will be identifying in your income statement. Those will be combined together, and the fixed costs would be separated from the rest. So a management income statement looks like the following. Total revenue or total sales minus variable cost equals the contribution margin. The contribution margin is really what's left, meaning that whatever is left of the total revenue minus the variable cost needs to contribute to the fixed cost, which means to the operational cost in order to run your operation. That is, if that's equal to 0, that's your break even. So just to explain it a little bit better, we haven't changed anything. The income statement is still an income statement. We just segregated things in a different way, variable cost versus fixed cost. We combined the variable cost and the cost of sale together in order to make as one bucket of variable cost. And then if we subtract that from the total revenue, that ends up being a contribution margin. The contribution margin contributes to the fixed cost in order to pay for that. And if the total revenue minus the variable cost minus the fixed cost equals 0, that is the break even. Next, we're going to take a practical example. So for the purpose of this practical example, we're going to start a company called JJ's Light Bulb Company. This company sells light bulbs at $1 a piece. The cost to make each light bulb is 50 cents, and we're going to pay a commission of 10 cents per light bulb for the salespeople. Knowing that, we can understand the variable cost for this business. The variable cost is very simple. It's the cost of sale plus the commission. So 60 cents of every dollar goes towards the variable cost for selling that light bulb. What's left is really the contribution margin. So how do we calculate the contribution margin? Is $1 minus 60 cents gives us 40 cents or 40%. Meaning 40% of every sale goes towards paying for the fixed cost. So if, for this practical example, we know that the business has an $800,000 per year fixed cost. That's what it requires in order to run the operation. It's $800,000. How much do we need to sell in total dollars in order to pay for the fixed cost of $800,000? Knowing that 40% of the total sale contributes to that. In order to do that, all we need to do is divide $800,000 by 40% or by 0.4, and that gives us $2 million, which means we need to sell $2 million worth of light bulbs in order to break even. 60% of it goes towards making the light bulb and paying for the commission, and the other 40% pays for the $800,000 a year fixed expenses that we have. That is a very important piece of information regardless of what business you're in. If you're a Fortune 500 company, or if you're a small business been around for many years, or you're a startup company. You can break that down all the way to how many dollars do you need to sell per month, per week, per day, even per hour, in order to get you to a point where you understand how much you need to sell in order for you to break even. After that, every dollar made after the break-even point, 40% of it contributes to the profit the other 60% still is contributing to the variable cost. So to take a very quick example, if this business makes $2,001, this business would have made 40 cents in profit. That would be profit or net profit before tax. Because 60 cents of that dollar, extra dollar that was made above and beyond the 2 million, contributes to the variable cost, and the other 40% contributes to the fixed cost. But since the fixed cost has already been paid completely, then that 40% contributes to the profit. So for this purpose, the cost structure for this business is as follows. 60% of every sale contributes to the variable cost, 40% contributes to the fixed cost, until a point in time where the fixed cost is completely paid, and then after that the 40% contributes to the profit. Next we're going to talk about goals and profits. In order to be profitable, you need to first break even. That's very important. We already understand that after you break even, every dollar that contributes to fixed cost will contribute to the profit. So every year as a business, you would need to set a goal for this year, for next year, as far as how much profit you're looking to make. If you don't have a goal, you don't have a potential. We already know, for the example that we've already taken, that the break-even for the light bulb company is $2 million per year. And we already know that $800,000 is fixed cost. So if we were to set a goal for the business to have $300,000 in profit for the year, how much total sales do we need to generate? If your answer is $2,300,000, it would be incorrect. And the reason is, from the $300,000 that's above the break-even, 60% of that, or 60 cents of every dollar, would need to go towards paying the variable costs. So in order to calculate how much we need in total sales to generate $300,000 in profit, we would need to divide $300,000 by 40 cents, or 40%, and that would give us $750,000 in total sales, above the break-even, which means the company would need to sell $2,750,000 before it can generate $300,000 in profit. That gives us the answer. Remember, it's 60% goes towards variable expense, 40% goes towards fixed expense. After fixed expense is paid off, then every dollar from the contribution margin goes towards profit. Next, this is a summary with a twist. So to summarize, in your financial statement, in your income statement or profit and loss statement, you need to categorize fixed expenses and variable expenses. Then you need to calculate the variable cost as a percentage of sale. Then you need to calculate the contribution margin, and that is basically the difference between the variable cost minus the 100%. That gives you the contribution margin as a percentage. In order to calculate break-even, all you need to do is divide your fixed cost by the contribution margin, and that will give you the break-even for that business. So fixed cost and contribution margin are extremely important for a break-even analysis. So in order to give this a twist, let's say your fixed expenses increased by $1. If your fixed expenses increased by $1, how much additional dollars do you need to generate in total sales in order for you to generate to cover for that fixed expense? The answer is $1 divided by 40%, or 0.4, which means $2.50. So that gives you an idea that if something increases, if a fixed expense increases, you need to generate enough revenue to cover that fixed expense. So if your rent, for example, increased by $100, then you would need to generate an additional $250 in sales in order for you to cover for the additional rise in the fixed expense before you can break even. Next, we're going to take another practical example, and this time it's Jimmy's Pencil Company. So this is using different numbers just to tell you that we can generate or calculate break even, even if it's a little bit of a different information. So for this purpose, we know the variable cost, total variable cost per year for this business, which is $596,000. We know the fixed cost is $109,200. And we know the total sales are $620,000 per year. So in order to generate the contribution margin, or to calculate the contribution margin, first we calculate the variable cost as a percentage of sale. That is $496 divided by $620,000. That gives us 0.8 or 80%. So the contribution margin is 100% minus 80%, which is 20% or 0.2. So now we know the contribution margin, we can calculate the break even. As you remember from the previous slides that we have, a break even is the fixed expenses divided by the contribution margin, which gives us $546,000. So that tells us that for this business, in order to break even, which means make no money, make no profit, cover all your expenses, this business needs to generate $546,000 per year. Now you can translate this into units. You can do it if your business is a service business. You can generate it and translate this number into units, or widgets, or gadgets, or hours. So if we were to assume in this example that each pencil sold is $1.50, then in order to generate or calculate how many pencils are sold in this business, then all we have to do is divide 546,000 by $1.50, and that gives us 364,000 pencils, or units, or hours, or widgets, or gadgets that you would need to sell in order to break even. So in this example, is this business a profitable business? Looking at the total sales, 620, knowing that the break even is 546, then yes, we could see that this business is profitable. How much? It's really not the difference between 620 and 546, because there's still portions of the revenue that will be generated will need to go towards the variable cost of the business. So only 20% of the difference will really generate or give you the answer for how much profit this business has, which is 620 minus 546 times 20% or 0.2. That gives us $14,800. So this business generated $14,800 in net profit before tax this year. Okay. Thank you. My name is JJ Risha. I am a member of Tech Coast Angels, and I look forward to help you with your business needs.